All right, let's get into it. Today, we're diving headfirst into one of the biggest philosophical battles in the entire stock market, the epic duel between value and growth investing. I mean, this is a clash that really defines how millions of people see the world and where they decide to put their money. So, let me ask you something right off the bat. When you look at a stock, are you the type of person who's hunting for a bargain today, or are you the type who's betting on what that company could become, say, 10 years down the road? Your answer pretty much places you into one of two very powerful camps. You've got the value investor on one side. This is your classic bargain hunter, right? They're sifting through the market looking for these solid, great companies that for whatever reason have been unfairly ignored. And then on the other side, you've got the growth investor, the futurist, who's all in on innovation, betting big on the companies that could literally change the world tomorrow. Okay, so let's really break this down. To get what this duel is all about, you've got to get inside the mind of each type of investor and see what really makes them tick. And believe me, it's way more than just numbers on a spreadsheet. We're talking about two totally different ways of looking at the world. You see, a value investor is all about the here and now. They want to see the proof. They're looking for real earnings, actual tangible assets, and that all-important margin of safety, which is just a fancy way of saying they want to buy something for less than what it's really worth. Think stable, mature companies, the kind that send you a dividend check. The growth investor, though, they're buying the story. They're chasing these visionary companies, usually in tech, that pour every single penny of profit right back into the business to grow as fast as humanly possible. So, how do these big ideas actually turn into decisions? Well, each of these tribes has its own special toolkit, a handful of key numbers and metrics they use to scan the market and pinpoint the exact companies that fit their strategy. And probably the most famous tool in that whole box is the price-to-earnings ratio, or just the PE ratio. In the simplest terms, it just tells you how many dollars you have to pay for $1 of a company's current profit. It's kind of like the market's go-to sticker price for a stock. But here's where it gets really interesting. Our two investors can look at the very same number and see complete opposites. The value investor spots a low PE and thinks, aha, that could be a bargain. But the growth investor, they see a high PE and just shrug, yep, that's the price of admission if you want a piece of a company that's going to take over the world. And that same logic applies to a bunch of other metrics too. Value investors, for instance, they just love a low price-to-book ratio. It means they aren't paying a huge premium for the company's hard assets. Its factories and inventory. And they love a high dividend yield. That's just cash in their pocket. Growth investors, they totally expect to see high price-to-book ratios because for them, the real value is in the patents and the ideas, not the buildings. And a dividend? Forget about it. They want that money reinvested for more growth. So is a high PE always a red flag for a value person or a green light for a growth person? Well, not quite. This is where a slightly smarter tool comes into play, the PEG ratio. What's brilliant about it is that it connects that PE ratio to how fast the company is expected to grow. It basically tells you if that high price tag is actually justified. It adds some much-needed context. But look, no strategy is foolproof. Every hero has their fatal flaw, right? And both the bargain hunter and the futurist have a specific kind of investment nightmare, a kryptonite, that they have to be on the lookout for constantly. These are the traps that can absolutely wreck their whole game plan. For the value investor, it's the thing they fear most, the dreaded value trap. This is a stock that looks cheap on paper, low PE, low PB, but it's cheap for a damn good reason. The business is broken. It's in a death spiral. That low price isn't a bargain, it's a warning sign. The growth investor's nightmare is something called growth disappointment. This is what happens when you pay a massive price for this amazing story about the future, but then that future just never shows up. And when a high-flying growth stock misses those sky-high expectations, its price doesn't just drift down, oh no, it can absolutely collapse. Now, picking the right stocks is obviously huge, but it's only half the story. Often, the real winner of this duel isn't decided by company fundamentals, but by these massive invisible forces, these huge macroeconomic tides that can lift one style up while pulling the other one under. So if we look back at history, who's got the winning record? Well, the data is kind of shocking, actually. Going back almost 100 years, value stocks have, on average, beaten growth stocks by about 4.4% a year. That is a huge long-term edge. It really suggests that over the very long run, patience and bargain hunting have paid off. But, and this is a really, really big but, that leadership isn't some constant thing. It moves in these powerful cycles that can last for a decade or more. I mean, think about it. After the dot-com bubble burst around 2000, value stocks had an amazing run. But then, for the entire decade from 2010 to 2020, big tech and growth stocks just left everything else in the dust. And then, after 2021, the pendulum started swinging back again. This back and forth is one of the most important things to understand about the market. So what's pulling the strings here? What is the one big variable that's powerful enough to decide which style wins for an entire decade at a time? Well, the answer, and this might surprise you, actually comes from the world of bonds. It's this incredibly powerful idea called equity duration. All it really does is measure how sensitive a stock is to changes in interest rates. And it all boils down to one simple question. When is a company expected to make the bulk of its money? Now or way out in the future? And that, right there, is the whole ballgame. Value stocks are what we call short-duration assets. Their profits, their dividends, it's all happening right now, in the present. Growth stocks are the exact opposite. They're long duration. Almost all of their value is tied up in the hope of gigantic profits that are expected way, way down the road. And this one difference makes them extremely sensitive to what interest rates are doing. So here's the mechanics of it. When interest rates go up, the value of money you expect to get in the future goes down. It's just a basic principle. $1 today is worth more than $1 10 years from now. Well, financial models use interest rates to discount all those future profits back to what they're worth today. So for a long-duration growth stock, where all the value is in those distant profits, even a small increase in interest rates can have a massive negative impact on what it's worth right now. So when you've got these crazy cycles and these unique risks for each style, how do the smartest investors handle this whole duel? Well, it's pretty simple, actually. They just refuse to pick a side. Instead, they find clever ways to get the best of both worlds. One of the most common hybrid strategies is called GARP, which stands for Growth at a Reasonable Price. These investors are looking for companies with really strong growth, for sure, but they draw a line in the sand. They refuse to pay just any price for it. And they use that PEG ratio we talked about earlier, often looking for a number below 1, to make sure they're getting all that growth at a sensible price. Another really powerful move is to add a quality screen to your process. This just means filtering for companies with absolutely rock-solid financials. We're talking high profitability, low debt, that kind of thing. For a value investor, this is the best defense you have against falling into a value trap. And for a growth investor, it helps make sure that the company's insane growth is built on a solid foundation, protecting them from that painful growth disappointment. And that kind of brings us full circle. This duel between value and growth, it's never going to end. But in a world where the economy and interest rates are always changing, maybe the biggest risk you can take is to nail your flag to just one mast. Maybe the real secret to success isn't being a pure bargain hunter or a pure futurist, but learning how to be a little bit of both.